Welcome to the Deep Dive. We're the podcast that takes those dense documents and pulls out the stuff you really need to know.
That's right. We cut through the noise to get to the core insights.
And today, we are plunging into, well, it's a document most people probably never read, but it's packed with info. The annual Form 10K.
Specifically, Netflix's latest filing for the year ended December 31st, 2024.
Exactly. Our mission here is simple. Uncover what Netflix itself is saying about its business, its money, and what keeps its bosses up at night, straight from the source.
Think of it as your inside look, minus all the legalese.
We'll skip the jargon and get right to what matters. So let's start with the basics. We all think we know Netflix, right? But how does the company describe itself in this official filing? What's its identity now?
Well, that's actually one of the most interesting shifts right off the bat. They're not just calling themselves a streaming service anymore.
Oh, what are they saying?
They frame themselves as one of the world's leading entertainment services.
Yeah?
It's subtle, but it signals a much broader ambition.
Entertainment. So beyond just shows and movies.
Exactly. They explicitly mention TV series, films, and games. And they back it up with the numbers. As of the end of 2024, they're reporting around 302 million paid memberships.
302 million. Wow.
Spread across over 190 countries. So yeah, global reach is definitely part of that leading entertainment service identity.
Okay, so that's the self-image. What about their strategy? How do they plan to keep leading?
Their stated core strategy is all about global business growth, but crucially, within their operating margin targets. So growth, but profitable growth.
And how do they do that?
It's multifaceted. They talk about constantly improving the member experience, obviously with compelling content, attracting new members, offering different price plans.
Like the ad-supported one?
Yes, including the ad-supported tier. Also driving conversation around their shows and films and, tweaking the user interface to keep people engaged.
That scale, over 300 million members. It's just hard to wrap your head around. How many people actually work there to support all this? Does the 10K give us a sense of their workforce structure?
It does. They reported having about 14,000 full-time employees at the end of 2024.
Okay, 14,000. And where are they based, mostly?
The breakdown's pretty interesting. A big chunk, 69%, are in the U.S. and Canada.
Makes sense.
Then 16% in Europe, the Middle East, and Africa. Only 4% in Latin America, and 11% in the Asia-Pacific region.
So still quite U.S.-centric in terms of staffing, despite the global membership.
It seems so, at least for the full-time staff. They do mention they also have a fluctuating number of part-time or temporary folks, especially in content production, and some of those are under collective bargaining agreements.
Right, which we'll probably touch on later with risks. Okay, so we have this picture of a global entertainment giant. Let's get into the money machine behind it. What did the 2024 financials look like? How did they actually perform?
The numbers are pretty strong. Looking at their consolidated highlights for 2024, total revenues were up 16% compared to 2023.
16% growth on their scale is impressive. What's the dollar figure?
Just over $39 billion.
$39 billion. Okay.
But maybe even more significant, their operating income jumped by 50%. A 50% increase.
Whoa, to what?
To over $10.4 billion. And tied to that, their operating margin expanded too, from 21% in 2023 up to 27% in 2024.
So they're not just making more money, they're keeping more of it as profit. That's efficient.
Exactly. It suggests improved efficiency, better cost management, or maybe pricing power. Likely a mix.
What about the absolute lifeblood, the subscribers? You mentioned 302 million total, but how did the growth look in 2024?
Yeah, the membership growth was really robust. They added, get this, 41.35 million net paid memberships during the year.
41 million net additions.
Net additions, which is a 40% increase in the rate of additions compared to 2023. So accelerating growth there, bringing the total paid members at year-end to just over 301 million. They seem to use 301 and 302 million interchangeably in different parts.
That's huge growth acceleration. What about the average revenue per user or per member? Did that go up too?
Only slightly. The average monthly revenue per paying membership went from $11.64 in 2023 to $11.70 in 2024.
So the big revenue jump was driven more by volume, by adding members, than by price hikes?
Primarily, yes. Though that small average increase suggests some pricing power or maybe a shift in the mix of plans people are choosing.
And you found something interesting about PVDs.
Oh, right. It's almost a historical footnote now, but it really highlights the shift. Their DVD by mail revenues dropped to completely zero in 2024.
Zero? From what?
From over $82 million in 2023.
Wow. End of an era, officially in the books.
Absolutely. It just underlines the total pivot to streaming. That business is gone.
So, with all this revenue, $39 billion, dollars, where's it mostly coming from? Is it still just the subscriptions?
Overwhelmingly, yes. It's primarily from those monthly membership fees you pay.
What about ads or merch or those live events they're starting to do?
They do mention revenue from ads, from the ad-supported plan, plus consumer products and live events. But, and this is direct language from the filing, they state these were not a material component of streaming revenues in 2022, 2023, or 2024.
Not material. Okay, so subscriptions are still king by a huge margin.
Definitely. The core business model remains centered on getting and keeping paying subscribers.
All right, we've seen the growth, the money coming in. But for a company like Netflix, content is everything, right? It's what we all talk about. How does that massive focus on content translate into their financial commitments? What are they spending?
This is where you really see the scale of their operation and maybe some of the risks. Their cost of revenues, a major expense line, is mostly the amortization of their content assets.
Amortization, meaning writing off the cost of shows and movies over time.
Exactly. And in 2024, they amortized over $15.3 billion worth of content.
15.3 billion just written off in 1 year. How does that compare to before?
It's up from over $14.1 billion in 2023. So that cost is growing.
How do they decide how fast to write it off?
They use what's called an accelerated method. They assume, probably correctly, that most viewing happens soon after release. So they expense more of the cost up front.
Right, everyone binges the new season right away.
Pretty much.
Yeah.
They note that films are amortized even faster than TV series. And on average, they expect over 90% of a licensed or produced show or movie's cost to be amortized within 4 years.
4 years, okay. But what about the total amount they're committed to spending on content in the future? That must be huge.
Oh, it's staggering. This is a key number. As of December 31st, 2024, they had total content obligations of $23.2 billion.
$23 billion they're already on the hook for.
Yes, and here's the really fascinating part. A huge chunk of that, $17 billion, isn't even on their main balance sheet yet.
Wait, how can that be? 17 billion in hidden commitments.
Well, hidden might be strong, it's disclosed here in the notes, but it's not on the primary balance sheet because it doesn't meet the specific accounting rules for recognition yet. Maybe the content isn't finished or available.
So they've promised to pay $17 billion more than what their main financial snapshot shows.
Essentially, yes. These are long-term commitments, and crucially, they're largely fixed. They have to pay this whether 5 people watch the show or 50 million. It's not tied to member usage.
That sounds like a massive bet. A $23 billion fixed bet on future content success.
It absolutely is. It highlights the immense financial pressure and risk inherent in their content-centric model.
Okay, so they're spending billions. How do they actually deliver all this content and get it from their servers to my screen?
They actually have their own global content delivery network, or CDN. It's called Open Connect.
Open Connect. So they built their own infrastructure for streaming.
Yes, specifically designed for efficiently streaming huge volumes of video data globally. But they don't do everything themselves.
Oh, okay. What do they rely on others for?
For the vast majority of their underlying computing needs, think processing power, storage, databases, they rely heavily on third-party cloud services.
Like AWS.
Specifically Amazon Web Services, yes. The filing explicitly mentions AWS as providing the vast majority of their computing infrastructure.
Interesting. So they're deeply tied to Amazon on the back end, even as they compete on the streaming front.
It's a common dynamic in tech, but yes, it represents a significant dependency.
Which probably leads us nicely into risks. No company is without challenges, and these 10K filings are usually pretty blunt about them. What are the big worries Netflix flags? What keeps them up at night?
They lay out quite a few, and they're not just boilerplate. They seem quite specific to their current situation.
Okay, like what? What stands out?
Well, first, and maybe most fundamentally, member attraction and retention. They flat out state that if their efforts here aren't successful, their business will be adversely affected.
That seems obvious, but they spell it out as key risk.
They do, and they list reasons people cancel. Not using it enough, needing to cut costs, think inflation, being unhappy with the content, or just preferring competitors. Macroeconomic conditions get a specific mention too.
So keeping subscribers happy and paying is priority number one, and it's getting harder. What else?
Intense competition and piracy. No surprise about competition, they face a ton of rivals. But their wording on piracy is really stark.
How so?
They call its fundamental proposition, basically, getting everything for free. so compelling and difficult to compete against. They acknowledge it's a major persistent threat.
It's unusual to see a company be that frank about piracy being compelling, isn't it?
It's rather direct, yes. It shows how seriously they view it.
Yeah.
Then there's regulation.
Government's getting involved.
Increasingly so globally.
Mhm.
Countries are updating laws, things like cultural support rules, to include streaming services like Netflix.
Meaning what? Quotas?
Yeah.
Taxes?
Could be content quotas forcing them to produce or show local content. Could be levies or investment obligations, basically taxes to fund local production.
Yeah.
Or even content review requirements. They specifically mention Europe, where individual countries can impose these kinds of rules.
That could really complicate their global strategy,
Yeah.
having different rules everywhere.
Absolutely. Then there's the tech side, cybersecurity and IT reliance.
Always a big one.
They talk about having security programs, but acknowledge the threats are always evolving. Viruses, malware, ransomware, even physical break-ins.
Anything new there?
They specifically call out that new features, and interestingly, the use of generative AI could intensify these cybersecurity risks.
AI adding new vulnerabilities. That's timely.
Very. And they reiterate that reliance on AWS. They mention the difficulty of switching providers as a potential vulnerability. And here's a kicker. They state they do not carry insurance to cover expenses related to such disruptions or unauthorized access.
No insurance for cyber attacks or major AWS outages. That seems bold.
It's certainly a significant risk acceptance. Then, human resources and labor disputes.
People problems.
Yeah, relying on key employees, maintaining their culture, competing for talent. Standard stuff, but important. But also risks from collective bargaining agreements.
Like the writers and actors strikes.
Exactly. Potential for strikes or work stoppages that halt production, delay content. That's a very real risk they highlight.
Okay, one more.
Finally, financial forecasting uncertainty. They admit that predicting things like future revenue, margins, and especially how well new things will do.
Like the ad plan or password sharing crackdown.
Precisely. They say predicting adoption for those is inherently difficult because they just don't have a long history with them.
So their own forecasts might be less reliable right now.
Potentially, yes. And they add that if viewing patterns change unexpectedly, they might have to revise how they amortize content, which could directly hit their financial results and even their stock price.
Okay, that's a lot to manage. Intense competition, global regulations, cyber threats without insurance, labor issues, massive fixed costs. Sounds incredibly complex.
It really is. The scale is immense, and
Yeah.
the challenges are multifaceted.
So given all that complexity and risk, how do they ensure they actually have control over their own operations, especially financial reporting? And what about how their own executives handle their stock? That's always something people watch.
Right. On the financial side, they state they have established internal controls over financial reporting, and management, including the co-CEOs and the CFO, assessed those controls and found them to be effective as of the end of 2024.
Standard procedure, but important for reassurance.
Yes, it's designed to provide reasonable assurance that the financial reporting is reliable. Now, how about the executives?
Yeah, the stock trading.
The filing reveals that several top execs and board members, including co-CEOs Ted Sarandos and Greg Peters, the CFO, the chief legal officer, they all entered into new Rule 10b5-1 trading plans late in 2024.
Okay, Rule 10b5-1 plans. I've heard of those. Remind us what they are exactly.
Essentially, they are prearranged plans that let company insiders, like executives, buy or sell their company's stock automatically according to a set schedule or formula.
And the point is to avoid insider trading accusations.
Exactly. The key is that the plan must be set up when the insider does not have material non-public information. So they set the plan up in advance during an approved window.
The so-called open window.
Right, usually after earnings are announced when everyone has the same info. The plan then executes trades later, even if the executive then knows something the public doesn't, because the decision to trade was made before they knew it.
So it provides a structured way for them to sell shares over time without raising red flags.
Correct. Netflix policy requires these plans to be adopted in an open window and pre-approved by their compliance officer. It's a mechanism for orderly transactions, even outside the normal trading windows, under specific legal conditions.
Got it. So it's about process and transparency for executive stock sales.
Precisely.
Okay, so wrapping this up, we've really taken a deep dive into Netflix's own story via their 2024 10K. We've seen this global giant still growing membership rapidly, boosting profits significantly.
But also facing enormous content costs, huge future financial commitments, and a whole minefield of risks: competition, piracy, regulation, cyber threats.
It paints a picture of a company at the peak of its game, maybe, but navigating some serious headwinds and strategic choices.
Definitely. Success, but complex and maybe fragile success.
Which leads to our final thought for you, the listener. Considering those massive fixed content obligations we talked about, that $23 billion commitment,
And their heavy reliance on external tech like AWS.
not to mention the new challenges from AI and those growing regulatory pressures around the world.
How might Netflix need to fundamentally change its strategy around how it acquires, produces, and distributes content in the coming years?
Yeah, what shifts might be necessary for them to stay dominant and financially successful long term in this evolving landscape? Something to think about.